Hi, Lee Phillips here. I'm an attorney and I dabble in taxes, so let's talk about tax for a minute. How is rental income taxed? Well, you can get rental income from the standard rent the place that the guy lives in. You can get rental income from renting equipment in your business and stuff. So what type of rental income do you have? It's generally passive. That means you can't, if it's a profit, you claim it as a profit and it goes against your income. If there's a loss, and real estate investors often have a loss, even some equipment rental stuff, because you're depreciating the rental property or you're depreciating the piece of equipment and it's generating a deduction, and that may be more than your rental income. If it is more than your rental income, then you have a loss, and that's a passive loss. That loss cannot be taken over and offset against your ordinary income or your non-passive income, your W-2, that sort of thing. So we have to keep our passive income and our passive losses over here separate from our standard, our ordinary income, our non-passive income, whatever you want to call this, okay? So we've got our passive income in the form of rents. And rents are always going to be passive income, basically. If there's a loss, the loss is going to be passive, and it can only be used to offset passive income. Except there are a couple of ways that we can take our standard real estate rents and losses, the depreciation, all of this stuff over here, and move it over to where we can actually offset it against our W-2 income, our ordinary income. Those two ways are: one, you become a real estate professional. In the old days, prior to 1986, we could take all of our passive losses generated through depreciation and offset against our rents. If we had the loss, we could automatically take it over and offset our ordinary income. And the big wigs in California and places that were making a fortune on their W-2s were going out and paying a fortune for real estate. They didn't care what the real estate cost because they used the depreciation to offset their regular W-2 income. And so in 86, the Congress finally said, no, time out. Can't do this. Passive stays over here in passive, active over here in non-passive active areas. But if I'm a real estate professional, and there are a lot of rules as to how you become a real estate professional. When the 86 law passed, basically what happened is the real estate lobby went to Congress and said, hey, wait a minute. We do real estate. This is our business. We should be able to claim the depreciation. We should be able to claim the expenses and everything else against our ordinary income, because it is our ordinary income. It's our business. And Congress said, yeah, okay. So if you qualify as a real estate professional, then suddenly your real estate depreciation and losses and everything can be offset against your ordinary income. The other way that you can do that is with short-term rentals. This Airbnb stuff that's coming up that everybody's cashing in on these days. That is not considered a real estate investment. That's considered a business. Now, there are a lot of rules associated with how you qualify for a short-term rental, the average stay under 7 days, you can't use it for yourself more than 14, all of these rules. But if you follow the rules, then any income and any losses, any depreciation, any expenses that you have in your short-term rental are not considered passive. They're considered business. And that's non-passive, standard, ordinary income and deductions and everything else. So people are doing these short-term rentals in order to get the depreciation, the tax benefits of real estate. And real estate is a tax shelter, guys. It's one of your big tax shelters. but your accountant's never brought you in, put his arm around you and said, we need to teach you how to use your real estate as a tax shelter. They don't do that. But you need to learn to use the real estate as a tax shelter. And you get the benefits of real estate in the tax shelter aspect, but if it's short-term rental, that goes against your ordinary income, your W-2 stuff. So, real estate, rental stuff, equipment, rental stuff, all passive. Depreciation, passive. Everything passive, unless you qualify as the real estate professional or it's a short-term rental, then it comes over into the standard income, ordinary income bracket. So this is Lee Phillips. I'm just talking about how you get your real estate or your rental income, how it's taxed, what you can do with it. Now don't forget to subscribe to us because we keep putting out new ones of these, and press the buttons below and like us and love us and all of that sort of garbage. And by the way, we are talking taxes. Don't forget to sign up for my 10 tax tips, because our ultimate goal is to save you 20% on your taxes. And I think we can do that. We'll teach you how to use your real estate as a tax shelter. So, and your other tax shelter, you know what it is? It's your little business. You need to learn to use your little business as a tax shelter too. Lee Phillips, we'll keep talking about taxes and legal stuff and asset protection and all the rest of this stuff.